Okay, this is brief exercise 5-3. It can be found on in your text on page 224. In this problem, they want us to prepare the journal entries. Uh, they do use the perpetual inventory system, and we're going to prepare the entries on Monroe Company's books. So let's look at the first entry, A. On March 2nd, Monroe Company sold $900,000 of merchandise. All right, right there, it should tell you, okay, Monroe Company is the seller. That's who we're making the entries for. If I'm selling an item under the perpetual method, I'm making two entries every time an item is sold. One to record the sale, one to record the cost of that sale. So the problem needs to give me both figures, the sales price and the cost of the items. And that's exactly what they do in that problem. So let's see. What we're going to do then is record an accounts receivable from Churchill. So we'll debit, you know what, I'll just do the first entry where I'm recording the sales, and they give me the amount of 900,000, and I'm going to debit my accounts receivable because we're going to receive from Churchill Company the amount that's due, that's owed to us, this 900,000. So Churchill Company purchased from us with $900,000 worth of merchandise, or on the other hand, we sold Churchill $900,000 worth of merchandise. We record the sales and we record an accounts receivable due from them. Then we want to record the entry for the cost of that sale. This is where I'm going to debit my cost of goods, and then I also want to reflect that I'm pulling this amount out of my inventory. Inventory is a resource. It shows up on your assets. Assets normally have a debit balance. If I want to reduce my assets, I'm going to credit it. So there's my entry for the cost of that sale. All right, let's look at B. On March 6th, Churchill Company returned 120,000 other merchandise purchased on March 2nd because it was defective. They give us the cost of the returned merchandise was 90,000. Again, as the seller, because we made the two entries to record that sale, we have to make the two entries to reverse that a portion of that sale. Now, when we record the return of the sale, we're not going to debit our sales account. We're going to debit a contra revenue account called sales returns and allowances. They give us the sales price at 120,000, so I can make that entry, that first entry, and I'll debit sales returns and allowances for the 120,000, and then I'll credit the accounts receivable because now Churchill doesn't owe us that much anymore, right? First they owed us the 900,000 of the original sale, and then they returned some items. So I need to give them a credit for the items that they did return. Now I don't want to bury this 120,000. Like over here, you do not want to make the debit to your sales account. As the manager of your business, the owner of your business, you want to know what is the amount that's being returned or allowances that we're giving to our customers. You want to track that. In order to track that, you're going to have a separate account for your sales returns and allowances. That's why you create this contra revenue account. It will net against your total sales. I mean, we could just debit sales, but now that information will be buried in the sales account. In order to extract it, you'd have to analyze your sales account transactions to determine which were the returns and allowances. This is a much easier way by creating this contra revenue account. Now you can just automatically, at any point in time, look at your financial statement and see what is the amount of your sales returns and allowances. If that's huge, you want to know why. You want to investigate what's happening there. Okay, I kind of went on a tangent there, but here's the first part of that entry where Churchill is returning the goods. So we have the sales returns and allowances, and they also give us the cost of the item that was returned. So I want to put that back into my inventory, and I'm putting it back at 90,000. They're saying it's defective, so that's probably the value of the inventory that I could sell, say at a sidewalk sale. So that's what what it's worth to me is the 90,000. And So we'll debit our inventory because we're putting it back into our inventory. It was returned back to us as Monroe Company, and we'll reduce our cost of goods sold now for that amount because we didn't sell that portion. So we had to cost of goods sold normally has a debit balance. I want to reduce my cost of goods sold, so I'll credit it. Okay, let's see what the entry is in C. On March 12th, Monroe Company received the balance due from Churchill Company. Okay, so this is when you want to look back at A and see what terms did we give Churchill Company, and we see that it's 210 net 30. Did they pay within the time frame? Well, the sale was on March 2nd, and they're paying on March 12th, so that's within the 10 days. So we're going to give them the 2%. So let's calculate that. And the way I can calculate the portion of that discount that I'm allotting to them is by looking at what is their accounts receivable. So here, Churchill Company owed us 900,000 initially. They returned 120. So the difference between the two gives me, let's see, it gives me 780,000. So with that 780,000, I can calculate the discount. I'll take 2% of that. Let me just put the entry here so you can see it as I'm discussing it. So here we're calculating in this line item, we're calculating the sales discount, which is 780,000 times the 2%, and that'll give me a discount of 15,600. Notice my accounts receivable. It's the net between the original sale of 900,000 less the return of the goods of 120,000. So I want to take that off my books because the customer is paying. Churchill is paying me, and they do not owe me the 780,000 anymore. Because they paid within the terms, they're only going to pay me cash less the discount. And you calculate the discount again by taking that accounts receivable times the terms, which is 2%, to figure out that sales discount. Now that sales discount is another contra revenue account. Again, as the owner or as the manager, you want to know how much are we giving in discounts. And so you can track it this way. Again, I could have debited my sales for this discount amount, but it would be buried in that sales account. In order to garnish the information, I would have to analyze the sales account to pull out the discount of 2% and see how many discounts, out of all our customers, who took the discounts and what did that amount to? Are our customers taking advantage of that discount? So you keep track of it in that manner with this contra revenue account. So those are all the entries that would be made for Monroe Company for those 3 business transactions. All right, that's it for BE5-3.